kind of downside is there, though, in equities, even with the hard landing that you described, given the fact that it's basically 7 stocks? They're all going to report earnings, or a lot of them, 5 of them, are going to report earnings this week. Probably they'll report really good earnings because they're in a transition spot, and everybody can keep saying kumbaya regardless of what's happening everywhere else.
Yeah, well, I mean, in the end, I mean, again, you know, we run models and we look at the interest rates versus equities and earnings, equity risk premium. You know, you're not going to get more than, say, 20 or 30% downside, I wouldn't have thought, from a sort of, you know, fair value elevated level. So you might go, you know, all the way, you know, back down to, you know, the sort of mid 3s or something like that, but, or 4, sorry. I mean, high 3s to 4. But, you know, you know, it's not, you know, it's yeah, I mean, that's your downside, I think.
You make 20 to 30% downside sound like it's nothing. You won't get more than 20 to 30% downside. When I listen to you, Dom, I don't think many people have heard this that much at all. The idea that we can double unemployment by the end of the year. The Federal Reserve doesn't see it this way at all, does it?
No, not officially. Obviously, they only had like 4.1%, I think. But I mean, you can look at Chris Waller's analysis; it's pretty clear, and you can look at a number of other things that are kind of looking a little bit extreme compared with previous cycles. I mean, the bank lending has slowed down massively. You certainly got elements of the service sector in the ISM as a little surprising. Household employment's a bit disappointing. So I don't think it's a shock to say. You also have to, I think, appreciate how extraordinary COVID was and what it did to the labour market, and therefore you shouldn't sort of rule out anything in a sense. I think it's quite reasonable, actually.